Imagine waking up one day and finding out that a financial crisis halfway across the globe is affecting the cost of your groceries, the value of your investments, or even your job security. How does this happen? Why does something thousands of miles away ripple through the US economy like a tidal wave? In this video, we'll unravel the intricate connections between global crises and the US economy, and more importantly, what it means for you. The global economy is more interconnected than ever. A decision made in Beijing, an earthquake in Turkey, or a war in Eastern Europe, all of these events can send shockwaves through financial markets, industries, and everyday life in the United States. Today, we're diving deep into how global crises impact the US economy. From inflation to unemployment and stock market fluctuations, we'll explore the tangible effects and uncover the mechanisms behind these global ripples. 1. What is a global crisis? A global crisis is an event that disrupts economies, societies, and governments worldwide. These crises can take many forms. Economic crises, like the 2008 global financial meltdown. Health crises, such as the COVID-19 pandemic. Geopolitical conflicts, wars, trade wars, and sanctions. Natural disasters, earthquakes, hurricanes, or even climate change events. These events don't happen in isolation. Thanks to globalization, they create ripple effects, influencing countries far removed from the crisis's epicenter. Section 2. The ripple effect on the US economy. Let's break down how these crises impact the US economy. 1. Supply chain disruptions. Example: the COVID-19 pandemic shut down factories in Asia, leading to shortages of goods in the US. Effect: higher prices for consumer goods and longer waiting times for products like cars and electronics. 2. Energy prices. Example: the Russia-Ukraine war caused a spike in oil and gas prices worldwide. Effect: higher fuel costs for American households and businesses, leading to inflationary pressure. 3. Financial markets. Example: a crisis in one country's banking system can cause global investors to panic. Effect: stock market volatility in the US, impacting retirement savings and investment portfolios. 4. Trade and exports. Example: tariffs or sanctions during trade wars reduce global trade volumes. Effect: US exporters lose markets, which can hurt American jobs in affected industries. 5. Inflation and interest rates. Example: global crises often force central banks, like the Federal Reserve, to respond. Effect: higher interest rates can slow down economic growth and make borrowing more expensive. Section 3. Real-life examples. 2008 financial crisis. A crisis that began with subprime mortgages in the US spread globally, leading to a recession that affected millions worldwide. COVID-19 pandemic. A health crisis turned economic disaster. Stimulus packages in the US helped mitigate immediate effects, but the long-term impact on inflation is still unfolding. Russia-Ukraine war. Beyond the tragic human cost, this conflict disrupted global energy markets, leading to surging gas prices in the US. Section 4. How the US responds to global crises. Monetary policy. The Federal Reserve adjusts interest rates to manage inflation or stimulate the economy. Fiscal policy. The government introduces stimulus packages or bailouts. Global collaboration. The US often works with international organizations like the IMF or World Bank to address global issues. Section 5. What can you do as a citizen? Stay informed about global events. Diversify your investments to protect against market volatility. Support policies that strengthen domestic industries and infrastructure. Why understanding matters. Global crises might seem distant and unrelated to your daily life, but their effects are closer than you think. By understanding how these events impact the US economy, you're better equipped to navigate uncertainties and make informed decisions for your future.